Welcome back everyone to the Audacious Money Witch channel where we talk about investing and trading stocks, bonds, and crypto assets around the world. We're getting to that time of year again. Some say it's going to be a year-end rally. Things are looking good.
Since 2023, I'm up over 1,000% right now. I don't plan on selling it. In fact, after today's correction, I plan on buying more. But I love what the CEO does. He's the man, the myth, the legend, Michael Saylor. The stock is MicroStrategy. What do you?
We used to call that Mr. MSTR. I've got to tell you, it's a Bitcoin play. I prefer to actually own Bitcoin. I know that Citron put some sort of short on it. All I can tell you is own Bitcoin. That's a winner.
At the same time, we have the Bitcoin to 100,000 rally still in place. The stock market is at an all-time high and investors are celebrating. It's one of the most comfortable and euphoric times I've ever been through in the stock market. And I've been through a lot. Generally, I'm an optimistic person. I like when the market's going up, so I'm enjoying it, but I still feel the need to pour a little cold water on this. And I'll be giving you different signs that we're getting close to a blow-off top. Things that I've noticed that give me pause and red flags. We'll be going through them next. We also have some shockingly weak earnings to expose.
Jeremy's Target stock had a rough day.
Have you ever heard of Target before? Well, if you have, it is a company I do own. Target is a position I'm building. I want to continue to build this. Do I want to buy more Target shares? Answer to that is absolutely yes.
Like, Target's one of the most comfortable stocks I would possibly feel like holding for the next 5 years in the market. Like, literally, if you told me I had to put all my money in one stock for the next 5 years, Target would be up there. I don't know if it'd be the stock, like, let's say I wasn't allowed to trade at all. I mean, if I just had to put all my money in one stock, I might feel pretty dang comfortable in Target, to be honest.
Showing you the two faces of the market. Underneath it all, it's not pretty. The underlying economy is not as rosy as the index is presenting to us. They are trying to trap you in. Ever heard of dead money? You don't want to leave your money for dead.
Are we getting to a market top? History doesn't repeat, but it rhymes. In this case, we see a lot of things happening right now that we saw in 2021. Although it's not the same, but I can't help but notice the similarity starting to creep back in. Seems like human nature is always the same. We get into the same problems that we did just a few years ago. Now, I don't have any problem with the market going up. I'm making a lot of gains this year, but at the same time, I think it's good for investors to keep a grasp on reality, to stay grounded, to not get caught up in investor fever. Investor sentiment, by my judgment, is at an all-time high right now, meaning it's about as positive as it can get. All the people believe right now is that the market's going to continue to go up and up into 2025. And this is a broad mindset that investor gets from time to time. There's no price too high to pay for a hot stock. Things are doing so well. The future is so bright that you are a fool if you have any level of skepticism whatsoever about a market rally. This is a type of extreme greed fever. We have so many gains for such a long period of time that we're getting to a point where we think we cannot lose, where everybody think that they're just gonna keep on winning. I believe that is a dangerous mindset to be trapped in.
The levered Bitcoin guy, Michael Saylor, he's the most popular guy in the room that everyone's talking about. His entire strategy is to lever up and buy as much Bitcoin as possible. And although I am in the Bitcoin trade with my Coinbase stock, the most trustworthy crypto broker in the world, when I look at this, it turns out levering up on Bitcoin this year was the best idea. He's up 621%. I see stuff like this happening and I go, wow, that doesn't look normal. So I zoomed out for over the entire MSTR stock chart, and I noticed the only other time that this has occurred, and it's had a parabolic move, and that was in March of 2000. Should we be concerned that the only other time we've seen this type of behavior was during the dot-com bubble? I don't know, but it does raise a bit of a red flag. The most followed companies on social media right now that has impeccable fever. Everyone is obsessed with Palantir right now. It has already 10x'd from 2022 bottom, which I grabbed some at 6.9 by the way. True story, but more importantly, if we look at just the price to sales multiple, it trades at a 50 price to sales. When the 2021 bubble collapsed, every stock that was trading above a 20 price to sales got completely decimated.
The last time that Buffett had this much cash relative to the size of Berkshire was back in June of 2005. We had a recession, a 50% drop in the stock market 2 years later. Now, Warren Buffett may be more conservative or more limited in what can he buy, so maybe he's just naturally growing more cash. This is also something that we didn't just see from Warren Buffett. Don't get me wrong, I'm not bearish, but I am looking more cautiously. I'll be taking some gains in some companies that have traded up to a very high valuation. Yes, Palantir. Now, we are getting to the dark side of the face for the market. We'll be discussing why Target is struggling while Walmart, Amazon, and Costco are all doing okay. Stock price is down a staggering 20%, so another huge plunge for Target because they missed big on their EPS. They also missed on their revenue, and they have given a soft guidance. So this was a triple miss, the worst situation for any stock. Target have different business model than Walmart, Amazon, and Costco, which focus primarily on value. Target has shifted its focus to not the lowest price, but the best experience. They have nicer plastic cards. They have Starbucks and Ulta Beauty in their store, but their prices are higher.
At Ulta inside Target.
Target just issued a major warning to the entire US economy. I'm going to show you what Target is warning about and why what's happening at Target is going to affect every retailer all around the world. Target shares tumble after retailer cut profit outlook as a company stockpile merchandise ahead of the US port strike. Holding the additional inventory was more expensive than the company expected, eroding earnings and adding to cost at a time when really competition is heating up from companies like Walmart, who's trying to drive prices lower to gain market share. But the real issue here isn't what the headlines suggest. What we know is demand is crumbling. The issue for retailers like Target prices are too high, and consumers are saying we can't afford it. Company executives said U.S. consumers spent less on non-essential items such as clothes and home products. What we're seeing from U.S. consumers is continued declines in demand, foot traffic, and spending, because what it's indicating is that income growth is too slow. The economy is too weak, and there's issues with the labor market such that consumers now can't afford to spend money like they used to.
We're seeing retailers like Nike, JD Sports, and Foot Lockers express the same concern that Target has, and it's a broad indication that the economy isn't experiencing a soft landing or no landing scenario. What it suggests is the economy is about to take another leg down. The consumer may be resilient, but they are still discerning. the poor Target performance probably doesn't bode well for the likes of Dollar General and Dollar Tree. And you can add every other retailer in the US and even around the world, like UK's JD Sports and China's Pinduoduo and Alibaba. The reality is economic data and demand doesn't go down in a straight line. There's going to be some bumps along the road. As we saw, British JD Sport Fashion warned the gloomy update sparked a sell-off among investors, sending shares down 15% and wiping more than £800 million. The poor figure from JD are likely to raise fear about another difficult winter for fashion retailers as high energy bills and increasing mortgage and rental costs for many continue to affect spending on non-essentials. Nike has separately warned about discounting ahead of Christmas. We can see from Nike stock to its retailers like Foot Locker showing signs that clearly the economy is weak. I do think JD Sport and Nike is a buy though. JD Sport has over 1,200 stores in the US. Nike accounts for 45% of JD's sales. JD CEO said, in the US, suppressed demand and consumers spend cautiously ahead of the election impacted performance in the key regions for the global retailer. Sales in North America overall declined in the quarter. Also, profits will be lower too.
Because what you're seeing is companies compete for the limited amount of money from consumers. The labor market isn't as strong as the stock market suggests, and savings rates for many Americans are very, very low at a time when we're looking for a turnaround in the economy. What these retailers are telling us is that it's about to get worse, and the evidence is very clear. As Target CEO tried to downplay the negative results in a call, analysts noting that issues like the port strike were a one-time problem. Why are they downplaying this? Because for several quarters now, what we have heard, it's all about the election, that the reason consumers aren't spending is due to the election uncertainty. They just need to know who's going to be the next president, and once they know, they're going to come out and spend. And what Target's saying is that wasn't the truth at all. We're seeing less foot traffic, we're seeing less spending, and that's exactly what I said. It's not about the election, it's about income growth is slowing. Delinquency rates are rising, and banks are tightening lending standards so consumers don't have access to the credit, because the next approach Target's going to take is cutting hours to its employees and laying people off.
The time that we want to buy is when there's blood in the streets. Warren Buffett said that nobody else wants to buy anything, and things are looking so bad. That is when we want to be a buyer of these stocks. When everything is perfect and the outlook is crystal clear. But as soon as we get a little bit of rainy day, like today, the algorithm can shift. The risk reward for these companies was much better 2 years ago. That was the time to be buying heavy on these stocks. But now, like I said, JD and Nike looks good. I'm just waiting for my Lulu now.
Okay, everyone, thank you for watching. Please comment, like, share, and subscribe.